Hello and welcome. I'm Suyash Maheshwari and you are watching Last Tick here on News 9, where we break down the day's action on Dalal Street. Now, Indian markets ended the second session of the new year 2024 on a muted note, with the last tick for Nifty coming in below the 21,700 mark. Now, overall, it was a session of two halves. In the morning trade, headliners were under intense selling pressure, which exacerbated after Nifty broke below the 21,700 mark. Now, we went on to touch a low of 21,555 on the index. And from there on, we were able to see a good bit of recovery, and Nifty was able to, claw back about 110 points from the day's low. At close, as you can see on your screen, Nifty was down 0.35% at 21,665 mark, whereas Sensex gave away about 380 points to end at 71,895 sort of levels, down about 0.5% or so. The broader markets, which by the way scaled a new record high at open, also slipped into the red as the session went by and ended there. Nifty Midcap 100 was down 0.18% and the index ended below the 46,400 mark, just about 11 points shy of it. The small cap index ended about 0.24%. Above the 15,000 sort of levels, and it was able to defend those levels on an intraday basis. Volatility slipped by about 0.7%. India VIX was down 0.68% at 14.58 levels on Tuesday. Among sectors, it was the banking and financials, auto and IT stocks that were the top drags on the drag on the market. Each of their respective indices ended about 1% lower today. On the other side, pharma, media and metal stocks ended in the green. The pharma index was the best performer today. It surged about 2.5% in today's trade and in fact even scaled a new record high amid strong growth prospects shared by various brokerages coupled with defensive buying. But with that, let's also welcome a very special guest, Mr. Deepan Mehta, Managing Director and CEO at Alexa Securities. Thank you for joining us here on News 9, sir. Now, in the last couple of months, Indian markets have run up and how? Like in December alone, Nifty surged by about 1,000 points or so. So my question is, valuation-wise, are we looking expensive at this point in time?
Yeah, good afternoon. Thank you for having me on your show. I mean, that's a no-brainer. Valuations are expensive. There's no denying that, and many reasons and many arguments. But it is becoming a bit of a challenge to find good quality businesses at reasonable valuations. And that's really is a constant struggle at this point of time. We've seen such spectacular rally in small mid-cap stocks and quality businesses that anything which has got a sustainable growth rate of 18% plus is easily trading at 50 times plus trailing 12-month earnings per share, which means the average price earnings to growth is in the region of 2.75 to almost 4. And typically, investors want to buy companies which are trading at a price earnings growth, PEG growth of around 2 times or so. So from that point of view, it is a bit of a challenge. And with stocks having moved up the way they are, one should certainly get a bit cautious.
And sir, January typically is a weak month for equities. Nifty, for instance, has declined in the last 5 Januaries. Why is that the case? And can we break that losing streak this time around?
I'm not going to offer an answer about why certain months are good and why certain months are not so good. But, Nifty's been up 8 years in a row. And, it's also a leap year. And I don't like leap years per se because all the problems in the markets, the big ones have happened in leap years, starting from 1992 Harshad Mehta scam to 2000 dot-com bubble, then 2008 also leap year. We had the global financial crisis, Lehman Brothers crisis. 2020 we had COVID. 2012 was that European crisis of the PIGS country, sovereign debt crisis. So I'm always a bit skeptical. On a historical basis, leap years haven't been good, so I want to be a bit cautious at this point of time.
Now, Mr. Mehta, as you pointed out, markets have in fact not performed all too well during leap years. This time around in 2024, what are the key risks that we are staring at?
Yeah, I know, this question I've been thinking about for a long time, even during the New Year holiday,
Hmm.
that what is it that, can worry the market? What is something which we are not accounting for?
Hmm.
And something which struck me when I saw the automobile figures today in the morning and the GST numbers yesterday and today, what struck me is that a lot of the momentum indicators are slightly below street expectations, below average. Like 10% GST is
Hmm.
not something which is, which will shake you that much. Even auto sales have been generally muted, negative for many companies, marginally positive. Cement numbers which came from UltraTech also were just 5% volume growth. So although we may be in a long-term growth trajectory in the economy, you
Hmm.
could have a period or a few pockets of slight dip in volumes per se.
Hmm.
And I think that's the biggest risk factor for this bull market, that until the last 2, 3 years or so, corporate earnings growth was a given. But I think it will get a bit more challenging. Also, the base effect will play a very important role. So from that point of view, I think earnings disappointment may keep the market pinned down,
Hmm.
may prevent it from just going away up and up and up, and it may act as a resistance. And on the bottom, on the downside, we have a lot of cash coming in, a
Hmm.
lot of liquidity coming in from domestic as well as foreign investors, and that may keep the market afloat. So these are the two counter factors. But one thing I'm certain, that we will not have such a broad-based rally as we had in 2023 and before. It's going to be far, far more selective. And investors may find that their portfolios, after having a brilliant outperformance in 2023, may now start to underperform in 2024.
So 2024 is not going to be another year of double digit returns, sir?
I don't know about that. You could have a double-digit return if HDFC, Reliance, Larsen and Toubro, Kotak Mahindra Bank, ICICI Bank, L&T, if they move up 15% or so, you will have a double-digit return in the Nifty.
Hmm.
But whether your portfolio will go double-digit, I don't know, because a lot of mid-cap, small-cap stocks, if there's a marginal disappointment in their earnings and you are trading at 50, 60 times or so, then you're going to see a sell-off. When the sell-off comes, it won't be 10, 50%. So that will be 30, 40% or so. So from that point of view, I just want to get a bit cautious. And something which Warren Buffett says always rings in my ear is that when the street is greedy, it's a time to be fearful. And when the street is fearful, it's time to be greedy. And at this point of time, the street is greedy.
So, Mr. Mehta, what should be the strategy for retail investors, especially those who were sitting on the sideline all through November and December, looking at markets which were, by the way, scaling, record highs on a daily basis? What should be their strategy for 2024, sir?
No, I think they should look for corrections to buy large cap stocks. Simple as that. I would still avoid mid caps unless they corrected by 30, 40%,
Hmm.
index correcting by 15, 20% or so. I'd wait for that point of time. But till then, if I have incremental capital to put to use, it has to be in large cap stocks. You could buy ETF also. I think this is going to be very difficult here for professional fund managers also to beat the Sensex and Nifty. So just going with a kind of an index Nifty or Sensex ETF, that also is just about fine. Specific sectors they could focus on is, I think, pharma will do well, and I think IT also will do well in this year. So these are the two sectors which one could be slightly overweight.
Now, sir, December quarter earnings is expected, is the season is expected to begin in 10 days from now, and as always, IT giants TCS and Infosys will be the first to come out with their results. Now, what are your expectations from the IT pack in general? Can we expect a shift in stance as far as the outlook is concerned regarding demand?
You're right. That's the point. Outlook will change.
Hmm.
The performance numbers may not be that great. They'll be same, stagnant, slightly lower. But management commentary is something I hope it's positive. Because a lot of uncertainty in the biggest economy in the world, that is US,
Hmm.
that uncertainty around rising interest rates seems to have been put to rest. So we're just waiting to see if confidence is coming back into corporate America over there, and whether they're again beginning to start spending on discretionary projects and start implementing all those multi-million dollar, multi-year contracts which they're given to Indian IT companies. Whether the implementation starts, that is the most important, I would say, qualitative and quantitative aspect to look for in this quarter's numbers for the software companies.
And Mr. Mehta, just a couple of weeks back, Infosys lost a $1.5 billion contract with a global player. Now, does that give us a cause of worry? Could that be an industry-wide issue where we can see termination of such contracts?
No, it's not an industry-wide issue. These contracts are done after a great deal of thought, and this is just a one-off in my tracking of decades of the industry. This first time I've come across a situation where such a large contract has been scrapped, and I don't think it's anything to do with Infosys. It's an internal issue of the customer, or maybe their change of plans.
All right. And sir, in 2023, we saw a dash for cash. Listed companies raised nearly 50,000, actually over 50,000 crores in 2023, which was a six-fold surge from 2022. But private capex has been sluggish. In fact, it has been a fraction of the overall economy, and it has been shrinking year over year. Why is that the case? And do you expect that to turn around, private capex, over the next few quarters?
I think private capex is picking up gradually. There's no denying that. If you see the order book position at all the capital goods manufacturing companies is pretty robust. Of course, government spending also is looking up significantly, especially on infrastructure. And PSUs themselves are in a expansionary mode. So I'm not too perturbed about that. Actually, excuse me, there's nothing really in the economy, medium to long term, which is troubling or which is worth noting on a negative side. It's just that you could have a soft quarter. It may be still strong, but the base effect is high. Certain factors are there where sales get pushed by a few months or weeks. And what happens in a market like this, which is priced to perfection, if a company comes with numbers which is slightly disappointing, like you expect it will do 18% and it does 16% earnings per share growth, the street will immediately punish it. It will punish you even if it does 18% growth, because that's all priced in. So unless the earnings come which are way beyond the whisper numbers or around the whisper number, means beyond what the actual analyst estimates are, you'll only have a sell on news kind of a syndrome. So I feel that 2024 is going to be more of a sell on news type of situation from time to time. Good companies come with good numbers, but not phenomenally better. Those are going to find correction over there, because also one needs to keep in mind that there's a lot of trading positions also in the market, in derivatives market, as well as the cash market. Leverage positions also are gradually inching up, margin trade funding or whatever. And generally, I think HNI portfolios are pretty well invested. A lot of momentum players have entered the market. So from that point of view, mild disappointments also can result in exaggerated moves.
Now, Mr. Mehta, considering that there are a lot of worries, for us in 2024, a lot of uncertainties in regard to elections. In fact, 62 countries are going for elections in 2024. Should one bolster their cash positions in their portfolios?
No, I'm all in favor of having a decent cash position in 2024, and not because of the elections per se, just that typically after such a good year, you should expect by law of averages slightly subpar returns per se. I mean, we've had 8 up years in the market. You could easily have a year which is flat to down. So from that point of view, also in terms of new ideas, where are the new ideas? I think a lot of sectors and stocks and investment themes have been well discovered, well researched, and to an extent overowned. I mean, like for example, railway stocks or defense stocks. To an extent, they're all well owned, well researched. Banks also, large cap banks per se, PSU banks, other PSUs. I mean, everything is now well discounted and well researched. You don't find a stock which is 4-5p multiple or 10-12p multiple and still able to sustain growth rates of 15-16% or so. So you look for sectors which have been laggards. Like I said, technology has been a laggard, large cap tech. Pharma has been a laggard. So you can expect them catch up to take place over there, but cannot expect fabulous returns over there because these are large companies. So when you look at the entire spectrum of where you want to search for good quality stocks at reasonable valuations, that is a very narrow subset.
All right. Can look at pharma stocks and technology stocks, as Mr. Mehta puts it. Sir, thank you for joining us here on News 9. Appreciate your thoughts.